So following the well-publicised corporate failures of recent years, BHS, Carillion, Thomas Cook, to name but a few, going concern has been a topic high on the profession's agenda for directors, accountants and auditors alike. In response, at the end of last year, the FRC published a new auditing standard on going concern, which comes into effect for December 19, which means that your auditors will have to do more work to get comfortable around what the directors have done to ensure that your company is a going concern. Then the pandemic hit with all the uncertainty that that brought and raised questions about what the going concern assumption means in the times of a global pandemic. Very usefully, back in May 2020, so at the height of the pandemic lockdown, the ICAW, together with the Institute of Chartered Accountants in Scotland, issued guidance for directors on their responsibilities for going concern. The guide reminds us that all accounts, including statutory accounts, measure past events, but that they are prepared on a going concern basis, i.e. assets and liabilities are measured and classified on the assumption that the entity can continue to trade for the foreseeable future. The most obvious example is a piece of equipment that's been purchased, measured at cost and included on the balance sheet as an asset, as the entity will generate future benefits from that asset. In a company, it's the director's responsibility to assess going concern. When they're preparing the accounts on a going concern basis, they need to assure that that basis is appropriate. Your accountant or auditor is likely to ask for evidence you have done this, particularly if you're subject to audit, given the new auditing standard on going concern. So what evidence can you show your auditors that you have considered the going concern assumption? Ideally, you'll have some cash flow forecasts which cover the foreseeable future. And for both directors and auditors, this needs to cover a period of at least 12 months from the date of approval of the financial statements. In normal times, companies have 9 months to file their accounts at Companies House. That's currently extended to 12 months. So the period that needs to be covered by the cash flow forecast could be significantly more than just the next year's budget. If we consider a December 19 year-end companies whose accounts are signed off in September 2020, their 2020 budgets will only cover a period of 3 months from approval of the accounts, definitely shorter than the foreseeable future defined as 12 months. Those cash flow forecasts prepared should be used to identify any cash shortfalls in the period, or even just points where the headroom becomes tight, and the directors need to plan actions to prevent or mitigate those shortfalls, and show those plans to the auditors. And cash flow forecasts are much better than evidence than profit and loss budgets. As we all know, cash is king and profitable companies can run out of cash. Preparing forecasts is looking into the future, so everyone recognizes that it's not a precise science. Directors need to make assumptions, apply them consistently, and be able to defend those assumptions. Directors should test the forecast for different assumptions, downside and upside, or think about developing a range of expectations, so a worst case, a base case, and a good case, to help identify the need for business critical decisions. A term that has been spoken a lot recently is the reverse stress test. This means identifying the assumptions that would result in the company running out of cash, and hopefully being able to show that the likelihood of those assumptions actually happening is remote, or that the directors can take appropriate mitigating action to prevent the company running out of cash. When developing a forecast, a cautious approach is best. You don't want to base your forecasts on unrealistically high expectations, for example, over sales. Other items to consider when preparing your financial statements during this pandemic. Your accounts do need to give a true and fair view. And to do that, you probably need to disclose the impact of COVID-19 on your business and the impact on the numbers in the accounts. If you're not a small company, you need to do this in your strategic report. And for all companies, you need to question whether you need some disclosure in the notes to your accounts as well. You also need to think about the valuation of the assets. Has COVID resulted in any impairment of your stock, debtors, or fixed assets? As with most things, clear disclosure of the impact of COVID should result in a clean audit report. When we went into the pandemic, the thought in the profession was that material uncertainty paragraphs around going concern would become more common. Although the experience that we've had is that the support from the government has given businesses the resources to see their way through the pandemic, at least up till now. And so actually we have seen fewer material uncertainties than I may have expected back in March and April.